What's up, everyone? Welcome back to the Outlier podcast. I have a familiar face, my friend Matt Caruso from Caruso Insights, which is a fantastic name, by the way. I use a similar name for my newsletter. Great minds think alike. Good to see you, my friend. How are you?
I'm good. Thanks for having me back, Eric. Appreciate it.
An absolute blast. So we were just talking about how there's so much money flowing out of your pockets that you just can't get into the small stocks anymore as much as you'd like to. Obviously, I say that in jest for people, but it reminds me, did you see that comment that Warren Buffett made pretty recently about some of the stuff that he's trying to do with his money? It was, I think, at the shareholders meeting, they were saying like, why do you have so much money in cash? Because it's a few $billions. And his response was perfect. His response was, I don't think anybody knows what to do with $1 billion. So
it's interesting. He also had another interesting comment because I didn't watch the whole thing by the kind of like the highlight reel, I guess, And someone asked him if you were younger or if you had less capital, what would you do? And it kind of goes back to what you and I were talking about, like the highest consistent returns is that you're limited by scale at a certain point. But he was saying he's confident that he could go around and find like a lot of goods like small, but like these 30, 40, 50% per year return, but they're small. Like you can't scale in, like, I would even say in the tens of millions or billions, definitely not billions, but things are out there if you hustle, but when you got a few billion, it's a different, people like to kind of chastise the big hedge fund guys or what, but when you're trading, a few thousand, a few 100,000, a few million, and you're trading 5 billion, it's a different ballgame.
yeah, it's one of those things that I feel like traders don't really think. I know I didn't think enough of. And again, like we were right before we were talking a little bit about scale. And it's not like I'm trading at this massive scale, even shadow of what those guys are. And I still run into liquid, especially in the options markets. I mean, that's one of the really tricky parts actually about derivatives is a lot of people will talk about, oh, like, what should I trade? What should I look at? And it's just like, once you're kind of at scale, there's only a workable universe available to you. It really is quite naturally limiting by itself. Now, I imagine for your progression from kind of the really small stocks into other things that fit the portfolio better, that there are probably more suitable alternatives, or is that overselling it, you think?
What do you mean by that, Eric? Maybe you could rephrase the
That
question.
when you go from your kind of small group of smaller stocks and you start looking at like the next level of market cap that fits the portfolio, is there a lot to pick from, or is it that starts scoping down really fast?
I think if you're like an individual investor, there's still like a large amount of scope. I think once you start kind of getting into like the hedge funds like situation, it changes. Liquidity becomes. I mean, I think that's why like look, Nvidia, like in all these AI stocks, megas that have been running so hot, like this disparity between those and everything else. Like I think they're getting like multiple tailwind. Like one is obviously the whole AI theme and what that could do, but I think the liquidity part is pulling them in. I mean, if you're a hedge fund guy or whatever, anyone big fund, and you want to have like exposure to the space. I mean, Nvidia is like, you don't get more liquid than that. So, they also get like the liquidity premium and all of that. So definitely helps. But if you're a smaller investor, there's still like a wide space that you can play with for sure.
Yeah, I imagine. And talk to me about that so far. I think we connected like first quarter of this year. I try to do like quarterly with is like people like you that I like, and just see like how the year is playing out. And I think if I recall correctly, towards the beginning of the year, it was a little bit of kind of back and forth, like trying to find good opportunities. How's that played out since last we spoke?
So I ended up getting positioned in a lot of good names, had some really great action. Actually, it's funny. We were talking last call about using options to hedge for a lot of these things, which I was using, and kind of in a good way because the earnings season was not kind. I think I counted just recently like 9 out of about 11 stocks like gap down on earnings for me. So, I know it's people say bad luck, but I hate luck. I feel like if you think bad luck, you start to invite it into your life. It's really just the probability curve. It's just I'm on the wrong side of the bell curve.
It's path.
Quarter. But you know what? Like, thankfully, I mean, jokes aside, the earnings hedges made it like okay. It was, I mean, it's not the it was frustrating because like the way I like to kind of build exposure, build positions, it takes some time to do that together. So if you get kind of knocked out of a lot of positions in earnings season and then markets were still strong, it's a little more difficult to like immediately reposition. So it was kind of unfortunate that they didn't kind of like gap and run our way, which would have been fantastic, but then also kind of forcing the repositioning. So it's been tricky, but one of the main tools I rely on is like the net highs, net lows to tell me like what kind of environment we're in.
I use it all the
And
time.
it's been super helpful because like there's been a lot of, I mean, just recently we had this leg up in AI like that kind of propelled everything. But besides that, if you're a trend follower, which is where I fall, like the past 2-3 months have been like deadly chop. So like thankfully, like I was able to kind of sidestep all of that chop and all that kind of frustration. So can't complain too much. And when I hit the opposite side of the bell curve of earnings reports, it'll be a different conversation.
One of the things I noticed, because that's actually one of the early connecting points, I think, between you and I is net highs, lows. I haven't found like a ton of people that used it, and it's something I've always used. That like accumulation, distribution, tick and trend, like those kinds of things. I've always liked those for breadth indicators. And one of the things I noticed really interesting for net highs, lows was the disparity between NASDAQ and the NYSE, the New York Stock Exchange. What do you make of that?
So, I think it's a really versatile tool that I think people maybe like sometimes misinterpret, or they don't get everything they can out of it. I think some people kind of clump it all together to get a reading. I like having them separate because the NASDAQ and NYSE stocks, they really kind of reflect like the different types of trends in the market, like the more speculative versus the more mature. That's the way I like to look at it. And so you can see like lately it's been very weak on the NASDAQ side of things because really apart from the large caps, everything else has been pretty weak. But even rather than kind of think of it like as a bull market, bear market indicator, for me, it's almost more of like an easy money, hard money indicator, because that's really what I think. Because I mean, it's not, nothing's perfect. Sometimes you can have a few net lows and we kind of turn around, we bounce the other way, or there's net highs and we roll over. But like the way I look at it is just like if you look at any environment, if you have net highs, it's probably like a much easier money environment because what it's really measuring is measuring like net liquidity flows. If more stocks are making 52-week highs and lows, like you have net money coming into the market. If it's the opposite, like, I mean, now just recently, if you've been in a few large caps, I mean, it's great, you're not complaining, but most other stocks have really been struggling. So I think a lot of people will look at advanced decline, I mean, and all these kind of things and just like take a hard stance of like, I need to be a bear or I need to be a bull. That's dangerous, man. Because if you look at, for example, the advanced decline line, another like breadth indicator people like that topped in 1998 and the market topped in 2000. So if you were just like screaming at the screen saying like, we have more decliners than advanced, well, I mean, you missed the whole .com rally. Like who wants to miss .com, So like what I also like, and that's kind of what I like about net highs, lows too, a little more than like just a pure divergence, like a advanced decline is, advanced decline, like that divergence can stay active for a long time while the trend persists. Like now we've had a bit of a disparity between net highs and net lows in the market, but usually that disparity is very short lived because if it is a healthy market, you'll get a few more stocks making new highs. It'll turn the corner much, much quicker. So I find it's a more versatile tool, but you have to put it in context instead of it being like this. I think it's like we're all trained from sports. Like we all have like our home team that we like, either I'm a bull or I'm a bear. And like people like really identify as that when that's their viewpoint. Like I think just be more flexible. I think it's like easy dollar environment or hard dollar environment. So how do you want to play?
I think the part also that I would tack on to that is I find the longer I'm in markets, the more I find people really are just interested in simple explanations. What's the one thing I can look at that gives me all the information, right? And kind of to your point, that one thing it's not there. Maybe stock price, maybe, right? Up, down, that's one thing. But yeah, I feel like whenever I talk to people about those kinds of things, I find that same lack of nuance. And to me, that's actually where a lot of the opportunities kind of emerge. Because especially for me, the way I will use any sort of breadth indicator, net highs, lows, whatever it is, it's not like a binary choice for me. It's positive or negative. I'm long, I'm short. Exactly as you're outlining. It's more of kind of an informative tool against the rest of what you see, because you can still find plenty of periods. I've run a massive study that overlays net highs, lows with the price of all the different indices and sectors just to see how well they line up. And like any sort of oscillator-ish indicator, there's a lot of noise in it. And understanding how to interpret those periods of noise becomes really important. And I always think like overlaying it with what you're seeing on the actual charts and the rest of the market tends to be a pretty good exercise when you're thinking about analyzing, let's say right now, for example, the NASDAQ, the net lows, not super crazy low, but definitely trending below zero for a little while now. What do you look for in that data, especially against when you look at something like the S&P 500, which just made essentially new highs again? How do you
Uh,
kind of layer those two?
So you always want to find like what's the trend of this cycle. So like to me, it's an important data point because it just kind of like it cuts through the noise. A 52-week higher low is an important event. It's not like advanced decline, like any stock could be up a nickel today or down a nickel, and that counts as like an up or down. So I mean, like generally more stocks are breaking down, but this cycle is just it's kind of odd where it just so happens that the stocks that are like exploding happen to be the largest market cap stocks in the world at the same time. So anyone kind of stepping back, if you're just forcing trades, so if you look at this, blindly, but the market's up, so I need to be long, but you're forcing trades in all the wrong groups, you're getting run over. The chop is immense if you're trying to buy breakouts and anything that hasn't been working. So for me, it's just kind of like, okay, we're in this hard dollar environment. At least let me figure out where the money's flowing. And once you see that, then you can kind of piece together the story. It's not always easy at the beginning of a trend, but I think it's been pretty clear for like a few weeks. If you were throwing money at anything except AI, large cap tech, I mean, you're not getting anywhere. I mean, in fact, if you look at a lot of industrial stocks and the rest, I mean, they've been like already in some decent sized corrections. So for me, it's really just about understanding what's really going on in the market because the indexes, they're not as descriptive as they used to. The concentration is too high. Like it's weird. I never thought I would say this, but like the Dow 30, the Dow Industrials 30, because it's like a price weighted index, probably gives like a better like diversified look at stocks than like the Nasdaq or S&P. I was having this discussion with a friend of mine recently. If you're like trying to bring a new fund to market and you want to sell it to retail, and you tell like the product officer like, hey, but you know what, like I have like 3 stocks or 30%, he's going to say like, you're too concentrated. We can't offer that to retail. But then after like the stock market itself has like basically 3 stocks being 25-26% of the total index. So the concentration is off the charts. I mean, how long it lasts, hard to know. I mean, it's interesting because then after always I know I'm kind of going off topic, but people always kind of say like, oh, maybe this time is different. Maybe like the large companies will like dominate unlike before. It's always the young upstarts that ultimately kind of I mean, if you kind of look even at this current cycle, how was this all kicked off? It was all kicked off with OpenAI. And I mean, they kind of like, it's just that, then all these other stocks are benefiting from the infrastructure play, but it was like this new upstart who kind of shook up what AI and turned it into like a generative AI we can all use. So, I mean, I know they're the largest group in the world, and they'll probably keep doing well and growing because they have such long inroads, but I still look to see who the next big players are going to be to kind of shake things. That's where the really monster percentage gains will be.
Especially from your perspective of stock trading. I mean, like trying to make sure that, it's actually funny listening to that because it reminds me that I kind of probably play the game a little bit on an easier mode, just in that one single sense. Options are by no means easier, to be clear, for most people. They add a tremendous amount of complexity. Yeah. But the one good part is you can create leverage out of thin air, essentially, just kind of there. But so when you're kind of looking through trying to find these different leaders now, what's that looking like for you? Where are they?
There's only one place. It's been the AI large cap, and not that everything else is broken. I mean, like there's still like you can look around. There's a lot of stocks that are healthy, they're basing, but they haven't had any momentum like moves for months. Like they've just been stuck sideways with general markets. It's been. I mean, there's someone I follow, Jason Goforth. He's from Sentiment Trader. I don't know if you know the company, but they do great kind of like technical research work and all the rest. And he had some great tweets because people will like. Anyone who says like, oh, this market is a bit narrow, people are like, oh, you're just angry because you're not invested super long. But like statistically, I mean, like there's no other market on record that's had such a disparity between the few and the many, So looking for next leaders, I mean, clearly like the AI space has been hot. We had big reversals today, which look like maybe at least a short term. I mean, momentum can carry it higher anyways, but typically it could be possibly a short term top. But besides that, there's other still healthy looking things, but you need them to come out of their bases and show that momentum ignition again, or else they can just kind of chop sideways we're in summer now. They can chop sideways for a couple of months easily. Yeah.
The next question I have then is when you try to think about the impact of the new regime on the capability for these different kinds of companies to grow, do you think that we're at like the early stages of where you might start catching parabolic growth? Do you think that this is kind of where most of these smaller companies might be trying to get all their stuff together? And then this is the kind of thing where, like, in a year from now, is where you would actually start to see them taking off? How do you think about that timeline for them?
Yeah, and this is, I think it's a mistake on my part that I wasn't a much more focused on the large cap names because I kind of saw the AI come and said, okay, NVIDIA is going to be the chip player. Who else is going to win? But I think the perfect playbook to answer your question is really the 90s and the internet, So the first wave really was, if you think about it, was infrastructure. Even things like Microsoft, like Windows is not really a product. It's just like the interface you use to access the other products. Like no one's using Windows. They're using stuff on Windows, or Compaq came out with a laptop, the portable computer and all the rest. So I think we're really in that infrastructure wave, which it can be a good wave. I mean, as we can see, but the infrastructure stocks, although they can have good sizable moves, they kind of get weighed down by the fact that they're already large companies in terms of percentage return. So if you look at the whole 90s bull market for internet, the wildest and craziest percentage movers, things like Yahoo and all the rest, I mean, those weren't the infrastructure plays. They were the people who were able to deliver the new experience to people. So I think there's a whole new wave. A good friend of mine was telling me recently he was looking at Y Combinator, who's sorry, I just hit my moving desk here. Sorry.
That's good. You just got a little bit
So
taller.
yeah, that's it. So a good friend of mine was telling me Y Combinator, which they help incubate all these new startups. Something like 95% of the new startups in the past year are AI related. So I mean, just think of the amount of ways that there's going to be new implementation of this technology and new outcomes. Even things like biotech, you can find diseases better, develop drugs better, faster. You can look at machinery, it could be more. There's going to be so many outputs. And I think it's these new young companies, they're going to have the like eye-watering moves, like stuff we haven't seen in a generation. So I'm still very excited. I think it's early days, and I think it's really is the real deal. It's not a buzzword. I mean, an AI. I think we don't see all of the output today, but like when people say, well, how do you know it's real? I look at just the amount of capital that people are investing in the space. I mean, like you're talking like, I mean, I think Elon was talking about how they're spending 4 or 5 billion a year with NVIDIA just in chips. Then there's the racks and all the rest. Like that's just one company. So like combined companies are spending tens of, if not hundreds of billions of dollars. Like you don't spend $100 billion unless you have a real path to how you're going to be able to monetize this stuff, So like if it was just hype, I think before they invested $100 billion collectively plus, they would make sure there's a real path to kind of use case for all this stuff. So I think it's a real revolution. It's going to bring on a whole bunch of interesting things, and the companies that are going to come out, I think, it's going to be the opportunity of a lifetime. I think in the next 5 years.
It's funny you say that. I've kind of echoed that in a couple different senses. I think one of the things that you brought up, though, that makes me chuckle a little bit was the idea of, not necessarily investing that much without a clear pipeline. But then I can't help but think of the metaverse. People were going in droves into the metaverse, and I don't see that much as much anymore. I'm actually curious from your perspective, is that anything that you think of at all?
Well, so the metaverse, yeah, I mean, I don't think it was at all like as broad based or the kind of capital outlay.
Definitely not. Definitely not.
And also, like it was kind of a bet on a new way for people to want to like operate. Like, I mean, maybe it's my age, and I don't consider myself an old person, but like, I find it weird to have to live in a digital world. Like, I actually find like having my phone on me all the time is annoying. And I'm sure maybe the younger crowd will disagree, but I think to AI's strength is that it can just be used in like a countless number of ways. It's not about like trying to like transform your physical space into a digital and like you have to adapt this new environment. Like AI can, like I said, it can help someone find a drug quicker. It can help like operate your vehicles more efficiently. There's like so many ways it could be incorporated. Like I think we're just scratching the surface. So I think it's just it's a much broader scope of applicability, which is going to make it easier to scale in all kinds of countless ways.
I think that's probably one of the most exciting things, actually, for my opinion as well. It's funny, I was doing a podcast with another buddy earlier this week about the impact of AI, and he has a little bit of the null opinion, which I find interesting, which is more of he thinks it might be a little bit overdone, oversold, have massive expectations it has to live up to in order to even justify the current valuations that we're seeing. And I sit here and I look at it, not saying that you disagree with either of those, but it sounds like as I hear you talking about it, I fall way more in line with your general thought process, where I truly view this as one of these once in a lifetime events. It's almost like when we saw the internet come out. That was a big deal. And I don't view this all that differently than that. They're different, right? You can't do a direct comparison. But if I think about the potential impact on top of the current infrastructure we have already, I mean, man, how far can this go? So this leads to the follow-on question for you. When you're thinking about playing this kind of move with this much opportunity and breadth, we talked about a little bit of the infrastructure side of things. That seems like a near-term play that could make sense. What's the follow-on for that playbook then? Because obviously we can kind of forecast the way we think this might go, where it might have greater impact than others, and I imagine that would probably impact your positioning decision.
So I think it's going to come out in two ways: the indirect and the direct way. And so like the indirect way is going to be all the companies where, I mean, like this, we'll talk about like the unfortunate side, things that people are scared of. But like, for example, they were showing how, I forget who was showing it, but basically they had like two phones. One was like an AI like calling to order food, and like the other was like an AI like receptionist who was like taking the order. And they were both having what sounded like two realistic people conversations. So
Never heard
basically,
that yet.
yeah, the call centers, you won't need all of those people. Like that's a huge cost saving. So everyone's always scared for jobs, but I think that's misplaced. Like every technological revolution, new jobs are found, better jobs. So I think, in the short term, maybe it's a bit of pain, but overall, like it should sort itself out. But so all the companies who figure out how to leverage it, you're going to see like a big boost to the bottom line for a lot of companies who get that right. Just like anyone who figure out how to leverage the internet. And I mean, think about it. People before were like the way things were shipped, the way things were ordered. I mean, think of how you have to have receptionists to take orders. I mean, like if you by today's standards, it's ridiculous that we did everything so manual. So those people will all get like the bottom line boost, I think. And then the more direct ways, and then people are going to come out just like with completely either never thought of before products and services, which is an option, or even just sometimes having a more streamlined AI-driven software or product can append like big company, like, a lot of times we look at these big companies like, oh, they're untouchable, they're so big. But like try and get a new product or a new process through a big company, all the committees you have to go through. Then there's the legacy investments. We just spent so much on this. How can we just like throw away this investment? So like we'll do it partially. And then you have these small upstarts that just like run ahead and take and eat their lunch, like the Netflix example is like the common one that Blockbuster could have seen what was coming. So I think so those who kind of leverage it directly and those like indirectly within the current ecosystem. And I think there's a lot of ways, different, we speak of the internet, but you could think of like, the, nuclear bomb, like how that kind of changed things. There was the energy and then the whole, like, space race and uranium stocks. And in the 60s, there was all of the like rocket booster stocks and aviation that took off. That was like a big thing. Or you could think of even the car, how that kind of revolutionized everything for domestic travel. I remember, it's funny, if you look at early reports, I like to study like technological revolutions. Like a lot of people, like you can see quotes where people be like, oh, a car will never be as, as useful as my horse. My horse can go everywhere. Like now you look back at that, you're saying like, what a narrow view. I mean, like, for him, maybe in his world where he saw like just like an open meadow, the horse is more useful. But as a society, like the car obviously is far better. Or there was trains before then, trains, how they changed everything. So I think this is another one of those cycles where, strap yourself in. It's going to be interesting. And all of those cycles didn't last a year. They all lasted for a decade or two. Like, I mean, big transformations. So and we look at the 90s as the internet transformation, but really you can even almost extend it into 2000. I mean, Google came out was 2004. So like it wasn't all just as internet dominated in the 2000s, but I mean, Meta was 2000s. Apple really kind of got super innovative in the 2000s, even though they were around before. So, I mean, the 2000s were really kind of the second act of like what was the 1990s.
It's funny that you segue into that, because I know that you study a lot of the just histories of markets and kind of different reference points. So that was going to be my next question for you, actually, which was looking at AI. What's the closest historical comparison you can think of for what we're seeing and what we can see? Obviously, you gave an overview of what it potentially will look like in total scope, but do you have a reference benchmark that comes to mind for it?
I think the internet's the best one because what was different about the internet, like I mentioned cars and cars were like they got better, but the car remained the car. Like I think the internet's a good example of where the internet provided this base layer for a platform that mutated in many unforeseen possible directions. So like that's why I think the internet's probably the best kind of comparison that we have, kind of thing, yeah. And the way it had that, like you had multiple, it's interesting because the internet even had multiple layers of infrastructure plays. So like the early infrastructure winners, like in the 80s and early 90s, were different than, let's say, Nortel, like at the end of the 90s, who was like doing the faster Ethernet. So then, like, the technology moves so quick, you need like another infrastructure rebuild 10 years later. So it's going to be, I think that's the best probably study. And it's similar, like how, Yahoo was the portal, the initial portal, and like Google was like the updated version of like better search. And then, like the iPhone was like the updated version of like the web browser, like it's in your phone and there's the app store. So you have these like reinventions along the way. So the only thing is with AI, and I think there's everything in general now, everything happens faster. So like, whereas stuff happened like, over, let's say, call that 20 years from 90 to more, really, like, Microsoft came out mid 80s. So call it, let's say, 20, 25 years, like that cycle. Maybe this shrinks to 10 or to 7 or 8, where you get like this massive wave of like unbelievable productivity. I mean, something's coming. I think we'll see what it is.
I think that that's like a really adept comparison, honestly. And it leads me to another thought, which is when you typically play at least a lot of your search criteria for the stocks you're looking for and stuff like that, it kind of exhibits a certain pattern. It'll, surge, base, or like that kind of thing. And when you look at the kind of potential roadmap something like this could have, and the investments in this could have, does that adjust the way you search for stocks because that time frame can potentially be compressed so much? Or is it something as you think that the model that you employ now is rigorous enough that it would adapt to that new scenario equally as well?
I think it's rigorous enough because, it's interesting. If you take like the recent NVIDIA weekly chart, or let's say ARM, which had a big move recently, and you can compare it to like these same leading stocks in every cycle. It's just it's so interesting. Like you could look at these stocks when they turn into these leaders, and it lasts for like that 6 months to a year and a half, typically, is like the cycle. And the charts just have a look, like the way their volatility, comes down and they trend. And so like even in past cycles, even though it lasted longer, you had a lot of stocks that, I mean, think of .com, right? They came out and it was like boom, 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 like just like these fast spikes and moves, and those are certain styles of stocks. So the fast, wild stuff has been seen in different ways. So I mean, it depends how adaptable you are, but like I don't think the compressed time frame is going to change the dynamics of how they operate. I mean, you can see even ARM recently came out, IPO'd, made a nice base, had that explosion move. Same with NVIDIA, all the rest. You went up, you based, you went up, you based, and you went up again. So recently I was trading Taiwan Semi, similar. You kind of broke out, you pulled back to your averages, and you had this last late move. So I think the patterns are going to be the same. I think that's the strength of like this process. It's a can slim growth investing. It's not like a big secret. I think it works. The hard part is just bringing everything together. Like there's no secret, there's no like super secret. It's just hard, like to balance everything, and everything always looks easier in hindsight. It's like an athlete. You can look at like a baseball player and say like, oh, okay, I can hit a baseball. Yeah, I know, but if the guy's throwing at 102 miles an hour, like it's a different than when someone's lobbing it to you in like the home field and you're knocking it out. So it's one of those things, like seems easy on the surface, but it just takes a lot of effort to make sure that every part of your system works cohesively, so you don't kind of mess it up at any point. Because if you get one part wrong, like let's say risk management is no good, or position size is no good, or market trend is no good, it's like you're gonna screw it up. It's like a car and your brakes don't work, or your accelerators don't work. Like one piece can't be broken, or it's not going to work. That's the hard part.
It's a great way to frame it. And especially for a system like yours, which is kind of predicated on consolidated positioning, but looking
Mhm.
for big moves. Has kind of the past year been difficult, or have you adjusted your sizing at all, or has it been kind of similar entry size protocols as you typically would run?
So it's pretty similar. Just there's been a lot of chop. So it's, again, if you look at the like the Nasdaq 100, it looks easier in the past year than for what the experience is for most other stocks out there that haven't had the large cap feel. So there's been a lot of chop under this. Like everyone forgets, like last March there was like a banking panic and all this other stuff that was like going on that people forget about, because like the market's been strong lately, but there's been a lot of chop. So I typically try and stay with normal positionings, but if I'm a little bit less like certain or the market's been a little more difficult, I just like cut them into a few more, like a few smaller buys. But I still like, so like when I start a position, I want to get at least 10% into a position. If I'm uncertain with markets, I'll start at 5-6%, but I force myself if it's going my way to get to where I need to get to. So like I don't just get smaller and stay smaller. I'll start smaller, but then I'll force my way in if it's working. That way, at least if it's a choppy environment, you're not just getting cut to pieces.
Yeah. And so when you're thinking about your buy campaigns, what's the time frame that you're employing between like your first entry at 10% or whatever the desirable is, and then the subsequent entries that you're using?
So I like to kind of build into a stock over, let's say, 1 or 2 weeks, typically. And when you get things right, like usually I found that the markets move in these nice like 3 to 5 month cycles where like you'll get these big powerful moves and the stocks go crazy, and then the good stocks will base and have another one again. Some will just top and you won't hear from them anymore. So like my personal like ideal favorite, and it doesn't always capture the whole move, but my ideal favorite is kind of build over 1 to 2 weeks, but do that over a few stocks when the market's coming out of a correction, and then 3 to 4 or 5 months later, you're selling most of that stuff off. Like if you look back historically at all the bull markets, you get these strong waves and these corrections, and then another wave, and really it comes in these waves.
Could you show me a little bit about the way that you might play something like ARM historically? The
Sure.
reason why I ask is because one of the things I find honestly so fascinating about the way that you trade is, well, I think a lot of traders in general, you eventually turn the corner where you're not afraid to buy something that's gone up, right? That's kind of like a base level. You got to get that sooner, it kind of thing. But what I find really interesting about the way that you're trading is, for me, like the process of doing that over like a week or 2 weeks, I would struggle with that. But I imagine my holding time is probably way shorter than yours. So I imagine that's why there's like that dissonance in my mind. So yeah, I was just curious if maybe we could take a look at ARM or really whatever else. I can grab anything that you want.
Yeah, for sure.
And I just want to explore what that looks like.
So this is a good one because this is one I actually put on recently. So if you can move the chart a little more to the left, like at the IPO period.
You want to go further back in time?
Yeah, further back, let's say last fall, last October or whatnot.
Got it.
Yeah, okay. It's a little bit of a scrunch chart, but
Do you want to go all and zoom in over here?
yeah, that area up until let's say February. I don't know if you can, yeah, like that'd be great. Yeah. Yeah. I don't know if you can adjust the scale on the right or make it a log, or it's just yeah, okay, that's better. Yeah. So, and you bring up a good point too, because a lot of people will ask me, like, Matt, you were a market maker, you're a day trader, like you must have these great insights from like intraday, and it brought a lot of help because I could see why patterns form. Like it's one thing to learn the theory, but to really see why they form that way. But to your point, it took me a long time to go from like making 200 trades in a day to like holding a stock for 3 months. Like for people who've never
It's
been on
crazy.
the shorter term side, it's like, wow, what's 3 months? But when you're used to like being in and out over and over and over, to like sit with the stock and you have this open profit and you're just watching it like bobble up and down, it's a like psychologically it's a very hard like
Yes.
transition to make, but that's a discussion for another day, I guess. So so this example here, so you can see how we looking at like that, see that low at 46.5 there that's sticking out. So that was kind of the corrective phase, and as we kind of start to work up the right side, yeah, into like, I think I'm not, what averages are those, Eric? That, let's say that yellow,
You mean the moving averages or
yeah,
the?
the movie.
Yeah, so there's probably more than we need. But there's like a 10, 20, 50. and then a 150, this really dark one.
Okay, yeah, that makes sense. Yeah, so when we ran up to that 50 the first time, you can see
Yep.
like yeah, so like yeah, so that's kind of where I put my first initial positioning on.
Okay.
And then after, as I kind of consolidated for a few days, and we had that other like kind of large candle that broke higher, I kind of added to the position. And then we went up one more time, and we kind of had that sideways consolidation. We kind of put that handle on the right side of the base. And so as it broke out of there on that day, I kind of finished off the buy. So this is actually, I told you earlier, like I think 9 out of 11 stocks gapped down for me, like on the recent earnings season. This is one that gapped up for me. So this kind of ran up into earnings. I had puts for protection, and I actually have an IPO sell rule that I used. First, it was from experience, and I went back to study and I saw how it was helpful. But basically, if I buy a stock coming out of a recent IPO and it goes up, let's say 80 to 100% from about the middle of the base, I'll just sell it into strength, because then typically you have the lockup expiry comes, and you have people who have stock from pennies who just want to take their big profit and buy their mansion. So just naturally you get that bad break a couple of months later, and it has to reset up like ARM ended up doing. So I kind of built that up in those stages on the way up. And then after coming out of that earnings, actually that first big candle that launched out of earnings, I sold that into like the 115, 120 area. And then 2 days later, the next morning, I was happy when it opened back at 100. And then the next day, I was miserable as it went to 160. But then ultimately, I think it fell back down to like 80 something. And now we had another recent leg up again. Yeah.
So then,
So this bad break, you can see there, that's most IPOs. If you look, even if they're successful longer term, there's always like after that initial like double, that really nasty break where insiders like if you got a stock as an employee at $1, and you suddenly have this multi-million-dollar, like, do you care if you're selling at 120 or 110 or 105? You just want to take the money before it disappears. So you end up having this really aggressive seller that comes to market after an IPO.
and then does your original thesis maintain? Are you looking to then enter back in, or do you view this as it made my move, I'm going elsewhere?
No, so I mean, like the young stocks are usually the nice stocks. So once it has that like bad post IPO break, it can set up again. Just needs to kind of set up a nice structure. This was a bit odd because it kind of had that bad break into April, and then just kind of like rolled back up to new highs. So it wasn't like a traditional the way it'll typically do. I mean, there's always a random variation. So I didn't catch this second move. I was playing with it a couple of days, and I got knocked out of it and ended up going without me. But they can set up again and have like nice continued legs. You just want to avoid that first nasty bad break after the IPO run up.
Yeah, it's actually really interesting to hear the way that you played it, because this was where I ended up getting in. But
Nice.
well, not nice, right? Is I listened to you getting in here and then doubling, right? I'm getting pennies on the dollar like a freaking peasant. But I guess that is the beauty of trying to find derivatives, is you don't need quite as much of a move in order to be happy with it. But it's not always, especially in stuff like this, like newer products, sometimes they don't offer derivatives, sometimes they're not liquid. So you kind of get priced out of some of those moves. Now, when you're looking at this, what would be the way you view reentry? Is this something that is kind of like on a watch list that you revisit until it sets up and it's lower on your priority list because there's other stuff that's kind of at a more advantageous stage of its growth? I'm curious how you kind of cycle through your stable of stocks that you conducted your original analysis on, you like it, you traded it, you got your exit, but the overall thesis may be essentially the same.
Yeah, so I keep like a general list. Like now there's about 100 stocks on it, where like there's two there's two criteria. Like I want those that have the good fundamental story behind them, and or that they're showing really great relative strength. So ideally the ones I actually trade have both. But if you don't keep them on a list and watch them, sometimes things change and then you just miss them. So I keep this big list. So for example, ARM is one where it's ever since I traded, it stayed on my list as a watch. Because just the fundamentals, the growth, the trajectory is all fantastic, but it had that bad break. So then you're looking for other opportunities, but you're still the daily, weekly review is still coming up in your process.
Got it. It makes sense too, especially because the way that you explain what you think that break comes from, to me, that would be a non-factor then, right? If it's just a bunch of insiders that are wanting to unwind their position,
Yeah, exactly.
I mean, I don't care. That doesn't change the fundamental picture of it. If that's
and it's funny, speaking to like what we spoke about before, I was saying people ask like, did your experience as a market maker and stuff help? Like I think that's somewhere like a situation like that, it helps because you can see the impact of like, again, like you go to school and everyone talks about efficient market and like rational investor. And like, then you've seen like like when you're like trading short term, you see fills where people are just like selling a stock, but in a ridiculous way. I mean, like saying, like, why didn't you take your time? You would have gotten like such better exit. Because for some people, their motivation is not about best price execution. Their motivation, and you see that it could be an institution who needs to liquidate, or I mean, I've seen all kinds of crazy stuff over the years where like they're forced liquidation or what, where sometimes it's not best price is not the priority. It's just get me out now. I want it now. It could be because I want a boat or because I'm forced or because of a legal proceeding or whatever. So it's interesting. Like, so, for some people, like they can't understand, like, why would somebody do that? Everyone has their pushes, and a lot of times it's not the rational investor mindset, and I always joke, like, I know like investors aren't rational because I've been irrational myself enough times that I've broken the model. So the market can't be that efficient.
Well, it's funny too. I've been following the whole GameStop saga just from specifically derivatives perspective. It's been absolutely fascinating. And they asked me a question about like there's GameStop right now is at like 25.59, and they were asking about these 125 calls that expire tomorrow. That expired tomorrow.
Are they worth
and
something?
They were massive open interest in these 125
Really?
calls. That yes. I'll hold on. I'll show it to you because it's
amazing.
It's hilarious.
I hope it's at least worth pennies. I mean, I hope it's not.
So it's literally it's bid at a penny, offered at 2. You have to come all the way down here. Look at this, 113,000 OI on this 125 call
for tomorrow. And you can still get. I feel like that's a free penny. I mean, obviously.
I like, and what I try to explain to people, they're really fascinated by the implied volatility of these really far out of the money options. And I try to explain to them, one, this is telling you that if you're buying this, you are buying this at a crazy price relative to what it is. The second thing is this kind of can be indicative from a market making perspective, how they view their risk, right? Mm-hmm. Because if you look at something like Apple, it'll still have kind of a crazy smile where if I close this down, like you can still see even in a near term expiration, it'll have a big smile, right? Where the out of the money puts are over 2,000% IV. But you don't typically see, the call side quite as high. But GameStop is one of those crazy products that it's just been wild to watch. From a market making perspective, that has got to be like a field day.
Yeah, it's wild. I mean, it can be dangerous. A lot of guys get caught on stuff like that because, well, now like people understand, but like, and I know everyone was railing on the guys who were short, and I think they were like abusing the short perspective. Like they really were.
They still are, yeah.
Overly short. They still are. So like they're in the wrong in that perspective. But like you can't. I mean, assuming the person's not like abusing their power as a short. Like I've seen like market makers. Sometimes they just get on the wrong side. They have no idea a story's coming, and they get run over. And like the poor guy was just like, he's just putting his trade on. He's not trying to manipulate markets. And the guy
trying to make like a market.
9 months of work. Because of some random, like, so I've seen both sides. I could have some sense of, sadness for the market maker sometimes. I've seen that side of things.
Well, especially from the retail side on this thing, I think there's a little bit of, just angst towards like the institutions. Yeah. And the market makers, they can play games. I'm sure you know that, right? But I mean, it's to the extent order flow still dictates the vast majority of their day. So yeah, it's this kind of thing's really interesting to watch. But pivoting out real quick, when we first spoke, well, 2 times ago, we were talking about the Fed and what the Fed was doing, interest rate environment. Then the last time we spoke, I think the market was still looking at 3 cuts, still pricing in 3 cuts.
Big change.
And now the market's looking at 2, Fed's still talking about 1. What do you make of the rate environment and the impact?
I think, look, I always like to say that the Federal Reserve, the federal funds rate should just follow the US 2-year yield. Like ultimately that's always where it gets to. And if they're too far below it, like they were like in, post financial crisis, it's like you're creating an asset bubble. If you're too far above it, like you were going to the financial crisis or like other periods, like you're creating like economic weakness. So, you have this big board of people, which really all they should just do is let the market decide the right interest rate, which is the capitalist free market way and the right way to do it. But if you look at the current way, like the 2-year yield has come off, and it's about, I think it's 3/4 of a point below federal funds, more or less. And I think, again, so much is adjusted or is affected by this large cap tech rally. Because if you look anywhere else, I think you can really see the economic weakness building. So if you look at the Canadian market, it's soft. If you look at even US market, equal weight, or small caps, or Russell, even S&P equal weight, I mean, hasn't done a whole lot for a number of months. If you look at European markets where they have like no technology sector, like France, I think last week fell like 10%, Germany fell 6-7%, Italian markets fell more. So I mean, like, obviously it's a completely different type of economy, but if you want to look at like the non-tech component, like just the pure economy, is probably a better representation, just for the fact that it doesn't have that distorted effects of Nvidia, Microsoft, Apple. So I think that's why ECB cut a quarter point, why Canada cut a quarter point, because I think they're starting to see, like, you know, when trying to balance the risks of inflation and economic weakness, it's not so clear a distinction anymore that inflation is the biggest problem. Like, inflation is getting closer to 2%. And I think at the same time, they're starting to say, like, we are actually getting weakness, you know, and by the time like it comes through, it's always late, you know, before everyone realizes it. But I think you are seeing that. And I think most stocks are reflecting that. It just so happens that, you know, the cohort of seven, you know, Magnificent Seven stocks are in a world of their own, and that distorts things. But everything else, I think, is starting to reflect the economic weakness. And so I think from that perspective, looking at the 2-year yield, I think the Fed is probably becoming a bit slow to kind of remove the restrictive stance. I know it's like from Powell's, and this is from Powell's perspective. If you put yourself in his shoes, it's easier, and he said this, it's easier to revive a weak economy than it is to stop inflation. As we've seen, inflation is very sticky. So I think he would rather, and then if you put yourself in his shoes, I probably would want to do the same thing. You're a little more willing to like make things break a little bit. You can say, okay, here's some QE, here's some lower rates, everyone, we're fine. That's a lot easier to stop than once inflation gets inside people's minds, and it's just self-fulfilling prophecy. So I think they probably see that things are starting to soften, but they're willing to play to the risk that the economy weakens without having inflation get away from them.
Yeah, I agree with that. And the other thing I was thinking about anyways is just the timeline, right? Like if the market is still pricing in 2 cuts, which is what I saw last time from the bond markets or the bond futures, and I think we're running out of time for that, man. Because when I'm considering the way that the Fed has played this so far, they've obviously been kind of slow rolling, and kind of for a lot of the reasons that you were just outlining. But then I look at whenever they make their first cut, the probability of there being a second cut in the very next meeting, I have to imagine, is very low, unless the economy is showing massive signs of weakness. When you think about playing the potential cut, well, is that anything that you are looking to play anyways? It sounds like it might not even be necessarily a big impact to the stuff you're trading, but I'm curious if you have a play around it.
Well, yeah, just like for myself, like, I mean, so like most stuff I do is kind of growth related, but I'm starting to look at some of, like, just, you know, there's different accounts that I have. Like, so I think some of the high dividend payers are going to be attractive, because I think if the economic slowness comes in, and most of these stocks have not done great, but I imagine a lot of them will start to kind of get a bid as interest rates fall, the yield will become even more, and you're going to get that kind of realignment. I think you'll get like that capital. Basically, it's like a bond proxy. And I think you're starting to see like even the TLT, which is like the bond ETF, trying to make that higher low. So I think that's probably the way you play it. I think if the market does correct, but then after ultimately this drop in rates is going to support the more speculative side of the market as well. Because like all this time, that's why it's been large caps, because with high rates, anything speculative is under pressure. And so I think when rates fall, that'll be another kind of notch in the belt for more speculative growth as well. So I'm starting to kind of look to see who would win coming out of that. And that's kind of the bond proxies, and that is just a trade I'm looking at as well.
Yeah, it's funny. It's so, whenever I talk to you, man, like there's so many parallels. We just have a slightly different way of like approaching markets. But I've even in the beginning of this year, I was long small caps, I was long bonds, trying to front run a little bit of that uptick that we first thought the cut was going to be in March. Then they moved it, then they moved it. Then I was just like, all right, man, fine. I'll take the trades lower, you know, I'll move the capital somewhere else. I'll go be a degen and load up in TQQs. Y'all twist my arm. But yeah, just The way that you're thinking about it is honestly very, very similar to mine. I think what I found interesting so far has been the dissonance between the market and what the Fed has actually done. Because I typically think the Fed and the market align a little more closely based on historic references that I saw in terms of kind of like policy messaging and then follow through. And this seems like a pretty big disparity. Last question for you. When you're looking at the rest of the year, what are you most interested in following along?
I think the election is going to have a big impact.
Interesting.
I mean, I don't want to get into politics, but you know, I think again, whether you're a Democrat or Republican, and so I always try and just like talk from an economic perspective. Like from an economic perspective, lower taxes is just better for the economy and the stock market, because I think lower taxes. Look, economics 101 is taxes. There's a dead weight loss to a tax. You know, the government kind of like has to tax you, and they're poorer allocators of resources than the individual is who actually earned it. So I think cutting tax will help. I don't know if Trump gets reelected, but I mean, I know Biden's not popular. I think if there is a change, I think people will, whether Trump gets the nomination or whatever, I think just from an economic perspective, that'll probably put a jolt, I think, into the economy. And I think that's why in 2016, he had his big tax cut plans, which he did put through, which helped the economy and all that. I think if you look at Canada, where we've had like higher taxes, they just raise the capital gains tax. And like, I always like to say, like these things, like people think these are long-term things, or, you know, it's not to want to help others, but I think this is a disservice to everyone, because look, Canada's productivity is the worst of the G7 now. We were one of the best, and now we're dead last in the I mean, Italy's doing better than us. You know what I mean? Like all these countries that you would think that you wouldn't think of as having stronger growth economies are doing better in terms of productivity in the rest. So
you better be careful throwing shade at Italy, because if I'm not mistaken, you might be checking them out soon.
Yeah, exactly. Yeah, I'm going down in July. I'm gonna do my economic inspection. That's why I'm going there.
Yeah. Well, you better be careful over there. You might run into a few dudes. But hey,
I have some family in some areas, so I have to make sure not to go to the local towns. I'll get thrown out. But no, but you know, so like, but these economic policies have a real impact. Like maybe not week to week, but looking over a year, 2 years, and the market's going to respond. And so I think that could be. I think if you get the catalyst, I mean, if you look at a perfect world of like, let's say taxes coming down, or you know, and I think this is where even, you know, Trump, I think his policy, he was a big spender. So, you know, that was maybe a negative. The government spends too much to become too big a part of the economy. So that's not, I'm not saying I'm a raving fan of either side. I always try and stay politically neutral in talks, but just at least on the tax side, if you get like any help from tax, then after you get falling interest rates and you get a technological revolution, I mean, you have three things like pushing in the same direction. And you get inflation under control. So you get like back to stable currency, lower rates, hopefully better taxes, and a technological that like sets up like a really promising 2025. So like, I think in a perfect world, because we've had like a big run to indexes because of the big cap tech, you correct into September, October, and then you get all of these catalysts at once, like Fed cutting, and it's like, I think 2025 could be a really exciting year.
You heard it here first. Plus, also, everybody, don't forget to clip that part about Matt talking trash about Italy's productivity. Got to make sure that gets out there. But Matt, as always, man, absolute pleasure hanging out with you. Chatting markets with you is one of my favorite things. It's always really enlightening. I love the historical references, honestly, that you bring, because markets obviously evolve, but there's always a lot of similarities. So thanks for sharing a lot of your experience with us today. As always, I'll throw links to your website, to your X or Twitter, or whatever I'm supposed to call it, in the notes below. But is there anywhere else that you want people to go check you out?
YouTube as well. You can check Caruso Insights on YouTube. I've been I put up videos whenever I get a chance to put something together.
Yeah, perfect. I'll tag you in this too, so it'll pop up on yours. Awesome. All right, guys, we will see you all later on.